this has to be this decade's Enron.
Well, with 900 million in assets, but 9 billion with a B in liabilities, yeah, I think you might be right.
I mean, time will tell whether or not this is criminal and I'll get prosecuted. But if it's not criminal,
it should be.
It should be.
Yeah, no question. Episode 192 of the Dan Bradbury Podcast.
Staring down the barrel of 200 episodes.
Ooh, it's coming close, my friend. And I can already tell that you are particularly excited about this podcast. You have, I believe you have what they refer to in the business as a podcast chubby.
I don't know what that means, and I don't want to know. Let's just move on. I'm going to put it down to being over-caffeinated. We've been in this beautiful studio.
Yes.
Locked up in a small box with a lot of caffeine, and it's going to be a high-speed, high-energy podcast.
Because it's a topic that you absolutely love. This is our biz finance episode.
Right. I mean, ultimately, this is about how to make your business make you more money.
Yeah. And to be fair, it's also inside the field of business finance. It's one of your bizarrely favorite topics. You are a strange one, my friend.
Look, it's interesting. On the worst to first theory, 10, 15 years ago or so, it must be now, marketing was my number one strength, and I'd grown businesses, but I hit a ceiling, and I was financially illiterate. And that's when I came across Keith Courtney.
By the way, when you say hit a ceiling, I would even go, and I'm not being disrespectful, it was a small ceiling comparatively to where you're at now.
Right. I think my upper limit was, I don't know, it was high six figures. I think I maybe got to somewhere between $500,000 and $800,000 in annual revenue.
Yeah.
Now, it was a very profitable business, but I got plateaued for 2 or 3 years, and I couldn't break through. And that's because if the only tool a man's got or a person's got is a hammer, they treat everything as though it was a nail. And the reality is, if the effect is missing, so is the cause.
Yes.
And I was trying to solve the wrong problem. And said a different way, or a slightly different analogy that dovetails nicely, is your business is only as strong as its weakest link.
And in that case, your weakest link was business finance.
Correct. And so, anybody listening to this, if finance is not your strong suit, there is gold here. Right?
Oh, pay attention. Yeah, listen up. You're going to
and even if finance is your strong suit, I'd still say, if you look by category, which industries are the wealthiest in the world? Banking and finance. Which per employee, the highest salaries?
And
banking
insurance,
and finance.
which is also all metrics driven.
Oh, can't miss the opportunity. Warren Buffett, puts down the largest part of his wealth down to one of his first acquisitions was an insurance company. And obviously multiple insurance companies, which enabled him to generate vast arrays of flow. But in order to run an insurance company, you have to be able to assess risk, and it's a whole degree of financial calculations. How likely is something to happen? What's going to be the damage if it does? It's numbers.
Yeah.
Right?
All right. Well, let's jump into the news, right? Because the news is so good.
Oh, this is ridiculous at the moment. I mean, because it's so volatile at the moment. So, high drama in the UK. So, at the time of recording this, the Chancellor's just released his autumn statement. And by the way, we should say for context, we've had a few Chancellors recently. Jeremy Hunt has just released the autumn statement, but specifically, the thing that caught my attention on the gov.uk, so the official kind of UK government website, it was the UK National Balance Sheet estimates for 2022.
Well, what are they? I'm interested to know. What's the balance sheet, Dan?
There's just a headline, Topher, which is the statistics release cancelled. So basically, they said, okay, well, we should have given you this data, the proposed release, but we've cancelled it because we're not ready. And then they cancelled it again because they're not ready.
This just boggles my brain that a government can get away with going, we'll get it to you next month. Like if this was a business, small business or even publicly traded, right? If you had one of your clients and you said, okay, we have our meeting. I want you to bring me the balance sheet. And then they showed up and they go, I don't have the balance sheet ready.
Right.
I can get it to you next month, though. What would you say?
Oh, well, look, I said, clearly you don't care about making money. I think that public companies are obligated to do it more quickly than privately held companies, but it's not about governance. That's not the reason why I'm saying it.
Mm-hmm.
It's about, are you dialed in? Because of course you could have a balance, because the defense of the government, by the way, would be like, yeah, well, because of the turmoil of the trust governments, right, we need to make sure that it's accurate, because we need to restore confidence. That's why they've delayed it. There's too much turmoil. It needs to be right, because we don't want to put something out there and be wrong. And I agree with that 100%.
Yeah, definitely. I would have to say better late and accurate than on time and deceptive, which it may not have been deceptive, but it would have been
On time and
that
wrong.
way. Yeah, on time and wrong, which would have been interpreted by the media as they're hiding something. But still, dude, this is problematic.
It just becomes an excuse where it gets pushed off, because you've got such a large amount of capital. The thing is, that's your job. I mean, and clearly it's not purely the chancellor's job. He's ultimately responsible. There's a whole host of people. It's like, you've got one job, dude. Like, do you know what I mean? It's kind of like, we've got to be dialed in with what the facts.
Somebody should be getting fired.
We can debate like how we interpret those facts and what we should do as a consequence of those facts, but if we haven't actually got the facts, we can't have a conversation. So it's kind of like deferring it is like, well, we're not quite ready yet, so you can't kick off. And it's clearly a political move, because you kind of go, well, the market for a period of time just goes calm, because it's like, okay, well, we can't judge it yet because we don't know the data.
By the way, do you feel that one of the reasons, or the reason for this, was just because of the change in leadership being so unstable? Did something fall through the cracks, or did they deliberately go, we can't release this? But is he in charge now of hiring people to do this? And is that the problem? There was just changeover, or do we even know?
Well, I mean, this... when I was speaking to the Prime Minister last week.
Yes. Yeah.
So
when you were having tea,
I'm not sure which Prime Minister we've got at the moment. Anyway, so from what I've read, here's how it would appear. Because of the turmoil, right? So inflation record high, etc. It's affecting the poorest even more. Then the trust government came in and pushed this regime, and the markets went crazy, and then the exchange rates and interest rate, and because of the high volatility in these variables, which have a massive impact, a small percentage increase on a monstrously large number is still a very, very, very big number. Yeah. So because of all that change. And some of it is open to interpretation. Mm-hmm. So there was a big debate about how Rishi Sunak, when he was Chancellor, how he changed an accounting rule and interpretation for how we analysed how big the deficit was, right? And some of it, and I won't get into the nuances here on this podcast, but some of that I kind of go, yeah, I can see why that accounting rule isn't relevant, and the one they're replacing it with is more relevant. Okay. But because of that change, they're kind of going, and the turmoil in the markets, it has massive swings. Yeah. So like the autumn statement, perfect example, Topher, is they were talking about this £50 billion black hole, like in terms of the deficit that the autumn statement is designed to plug. But some people, people are interpreting the data saying there isn't even any hole. It's all down to how the facts and data has been interpreted.
Look at this screen. I think there's a pretty big hole. I think there's a really big hole when you look at that screen right there, and there's no balance sheet there. But that's just me.
Right. Well, look, because ultimately you've got to say, we've got to get the facts, and then what do we do about it? And it feels like it's people politics. I'm not saying I'm for or against who's in power, etc. I'll also say it's easy to criticize. I don't want to defend the government, but it's easy to criticize because, after all, it is their job. But like trying to unpick this stuff, I mean, it's crazy. I mean, but ultimately, you're right. It comes back to leadership, in my opinion. The right people for the job, the right leadership, because you can't tolerate this shit.
I think there's a thing we're missing here, which is directly applicable to our audience as well, right?
Thank you.
Yeah. And that is that because you said something, right? That there was a new classification, a new way of interpreting things. And I think from a small business perspective, which is the majority of the people who are listening to this, just because you're doing it one way right now doesn't mean it's the right way. There are multiple ways to get to those numbers, and
Well,
I don't even know what I'm trying to say there. You do, right?
Let me give you one example,
Yeah.
okay, that applies to most small businesses. You can give me the same data sets, right? And I can give you 3 radically different P&Ls based upon one simple definition or policy or
Okay.
rule
Yeah.
or classification, and that is the revenue recognition policy.
Accrual versus cash.
Yeah, accrual versus
Yeah.
cash could be one, but so for those not listening, I'll try and do this very concise.
For those not listening, are people just watching watching this?
Yeah, I'm not sure. Too much caffeine. All right, so look, pay attention, because this is going to make a big. Right now, I can have a radical swing in your profits, and what I'm going to say in the next 30 seconds. Cash accounting says when cash comes in or cash goes out, it's recorded to the P&L, basically,
Right.
simplistically. That's it. So it doesn't matter when you sold the thing; it's when you receive the money. It doesn't matter when you consume the good or service; it's when you
Deliver the service.
the cash leaves your bank account. That's cash accounting, and that'll make your P&L look one way. But accrual accounting relates to the activity.
Right.
So if I deliver the service, I'm earning the money whether or not I get paid in advance or 90 days later. I'm earning the money when I'm delivering the service. And when I consume the good or service, or the employee does the work, whether or not I give them the cash, I owe them the money. So it is recorded in the P&L. That's a very simplistic definition. But if all of a sudden you're in a business where, for example, you get paid in advance, but you pay your suppliers in arrears, like in the month that you get paid. So let's say in January, let's say you sell pens. January, you go and get a load of pens from a supplier on 90-day terms, and you sell them immediately, right? And you can make £100,000 worth of sales, okay? But you don't pay the supplier, and let's say it costs you £50,000 to do that. You don't pay them till end of March,
90-day
or the 1st of April.
Yeah, that's what I was going to say. There's a difference between 90 days and 91 days if you're doing quarterly profits.
Right. So then all of a sudden you kind of go, okay, I've got 100,000 in revenue in Q1 and no cost. Great. I've made 100,000 in profit on a cash basis.
Yep.
And then in Q2, I've got no revenue, but I've got a £50,000 loss. And a bad business coach or advisor would say, hey, Topher, like, you need to do more of the crap that you were doing in Q1 and stop doing what you're doing in Q2.
Yeah.
And clearly that's illogical and unsustainable.
We're stopping right there. We're stopping right there, because what you just said is so important, right? When you're looking for a business coach, a business mentor, a business advisor, if they aren't financially literate, they could be right? Like, they could really screw you over by their advice.
I don't want to get sued because I'm not a lawyer. I'm not a financial advisor. There's a well-known business coaching franchise.
I think I know the one you're talking about.
I can neither confirm nor deny.
By the way, in my opinion, they are not a business coaching franchise. They are a life coaching franchise that calls themselves a business coaching franchise. But that's neither here nor there. Keep going. I'm with you on this.
Yeah. Let's keep the action going. So what
the action going?
Yeah, keep the action going. Okay. Yeah, this is the action.
Yeah.
So that franchisor does not teach, or the last time I looked at it, which was fairly recently, they did not teach any financial literacy skills.
Yep.
So really, the bulk of their syllabus that they teach their franchisees to teach the businesses is sales and marketing.
I was going to say it's sales and marketing. That's all it is.
It's slight oversimplification, so that's a little bit unfair.
Little bit of business
and I'm
strategy.
not saying that they don't add value, right? I'm not saying that they don't. I know some people that have worked for that franchise that are phenomenal, but actually the best ones, I'm thinking of one in particular who I think is spectacular, who's since left the franchise, is totally financially illiterate. Like, he recognized that was a gap that wasn't being fulfilled for his clients, and he wasn't getting it from the franchisor.
Let me ask you this: if you don't have a yes to this question, I've just come up with our next product to co-create. Do you have a list of questions that somebody could take to their business coach, their business advisor, their mastermind group, or whatever, to ask them that, based upon the answers of those questions, would be able to vet how financially literate those advisors are.
Oh, that's good. So I'm going to say no. There is, in part, in our kind of finance, our online finance masterclass, which we can put a link to in the show notes. They are smattered across those 7-8 modules.
Yeah.
But they're certainly not condensed in one easy consumable format. So I think that's a great idea.
Yeah. Well, I'll tell you what. So if you're listening to this or watching it and you're interested in something like that, drop a note, put a comment, send a like, whatever. Find a way for us to get in touch with you. Tell us you want that. And if we get enough people who say they want that questionnaire, we'll create it.
Yeah. And look, I was oversimplistic on the revenue recognition policy. A great book that's separate from our book of the week.
I was just going to say, are you foreshadowing the book of the week, or are we going to have two books?
2 books.
Of course, that's how we play.
It's about the Enron crash. It's called The Smartest Guys in the Room.
Yes.
Now, I'm not going to lie. You've got to have a degree of financial literacy because I don't want to say it's complex, but if you don't know if you can't read your way around a balance sheet,
there's a lot of jargon in the book.
It'll be too much.
Yeah.
However, effectively, that book is about revenue recognition policies because it can be a lot more complicated than just cash and accrual, the simple example that I just gave.
Yeah.
And that's basically how Enron, because I will say, even though there's no question it was fraud and people went to prison, appropriately so.
Yes.
A lot of what they did was not fraud. It was totally legal and within accounting rules because they manipulated the revenue recognition policy. And so the same data that occurred, the same activities, we do a contract, etc., showed radically different P&Ls and balance sheets. And that was used to mislead investors. But the largest part of what happened, and it's detailed in this book, was straight up legal. Now, it might have been immoral, it might have been distasteful, it might have been used to take advantage, but it was not illegal.
Right.
Obviously, it's the 10% that they did do that took them over the line, that sent them to prison, appropriately so. But
I mean, let's face it, the prison they went to really wasn't that harsh.
I don't know. I haven't visited it.
Yeah. Well, I mean, in the white collar crime world, they're not going to Rikers. They're
going to day camp.
Yeah, exactly. Yeah.
Well, so look, and so trying it back to the small business owner.
I can't believe I actually remembered the name Rikers.
That's impressive. Tying it back to the small business owner, if you don't know your numbers, you don't know your business. And the problem is, here's where people like, oh, well, I'm not a big corporation. What's the relevance? The fact is, you're paying taxes or not paying taxes based upon what your accountant has assumed how your business operates. Mm-hmm. And just because they're an accountant
does not mean they have the right answer.
The accountants are supposed to reflect the reality of operations. And if anybody listening to this pays any attention to the financial stuff that was the documents that your accountant gives you to sign, you are disclaiming the crap out of your accountant because they're saying we prepared these accounts based upon the information that you gave us. Yeah. Which means that if you've not been explicit about, well, oh, hey, we sell, but we get paid in advance, and the accountant has assumed you get paid in arrears, your accounts are wrong. If you are, for me in this training business, if somebody prepays a year's of mastermind in advance, I haven't earned the money.
Correct.
I'm earning a 12th of that money every month, regardless of when they pay me.
And by the way, that money goes into a separate account.
Correct. Yeah. Because it's not mine, and that should be reflected. But if the invoice just says consulting or training, and the accountant assumes it's a workshop and the client's paid for the workshop and it's been delivered and it shows that I'll be overstating my profits. It's not reflective of reality, which, by the way, will mean you'll pay tax too soon.
Yeah, I was just going to ask you, by the way, in the UK, on an accrual form, they pay the money. Do you have to pay the tax on it right away, or do you get to stretch that tax out as you earn the...
I'm definitely... hold on.
Oh, yeah.
It's an appropriate shot.
Yeah.
What am I not?
An accountant.
What am I not?
A lawyer.
What am I not? Financial advisor.
Financial advisor.
I'll have them say, what am I? Terribly good looking? No. Anyway.
A god among business owners. I know where my bread's buttered.
Well, Warren Buffett's protege. No, anyway. So the he didn't say that, but he is a fan of the podcast.
Oh, he's a longtime listener.
He's listening.
First time caller.
He's getting tips right now. I've completely lost the track of thought. I was making some relevant point.
I would love to get a cease and desist from Berkshire Hathaway, and he goes, "Stop saying I'm a listener of this show." That
would mortify me because it'd be like my uncle that I love telling me of, but I would also love it and cherish it. I would frame it.
Oh yeah,
100%. I would frame it. So I wish I was that big a deal to matter that I could get a cease and desist. There was some point near.
Oh God! Why don't we just move on to the? What are we on? Are we still on News of the Week?
Yeah, we are.
We should probably just carry it into the fail of the week anyway, because the fail of the week is hilarious.
It ties in. It illustrates the point, right? So I've remembered.
Oh, okay.
So interlude. The point is your account's wrong. So if you are overstating profits, great, you get to take the dividends soon, but you're paying tax that you don't need to pay because you haven't earned the profits yet.
Yeah.
And that's why when companies go bust, by the way, typically when they go under, all of a sudden all these liabilities come out of nowhere and you're found to owe all this money. Well, you always owed that money. It's just that your accounts didn't reflect that, because the reality is you don't know what's fucking going on in your own business, and then shame on you, right? In fact, great story that parlays perfectly into
the fail of the week. Yeah.
So a while ago, I was chatting to my accountant of a business that I invested in, and I was unsure about the bookkeeper for this particular business. And I said to the accountant, I said, look, I could go either way. They're either not good enough and they need to go, but maybe they're fine now. I'm being a little bit overly paranoid. Could you check it out and tell me?
My guess already on this one is that you were not overly paranoid.
Well, can you check it out and let me know, whether or not, and he said, well, do you see anything? I'm like, no, I don't see anything wrong.
But there was something your subconscious saw, you saw an inconsistency somewhere.
Well, the good news is you're going down a road and my accountant went the exact opposite way. So my accountant went, Dan, yes, of course, I'll happily dive deeper and have a look for you to check. And my accountant's rarely is he very opinionated. He's always, it's felt, and he went, but I'm almost certain that this bookkeeper is competent. I said,
really?
Why do you say that?
See, this was a twist, a plot twist I was not expecting.
Exactly. He said, why do you say that, Chris? And he said, because you're dialed into your numbers. He goes, the people that don't look at their numbers and don't ask about the numbers are the people that there's a big surprise and it's catastrophic and there's big swings. And he goes, the fact that you're looking, because I spoke into some minutiae, I see this journal entry, I haven't seen this journal entry that you'd said at year end, it's not been entered in the system. So just check that I'm not off base. And he said, well, might there be a few little details that are a bit sloppy? Yeah, might they be overworked a little bit? Maybe, but he goes, I'll look for you. So I want to be clear. I'm not saying, not taking it as read. He said, I'll look for you. But he goes, I'm telling you right now, I'm almost certain it'll be okay. It's just a question about whether the bookkeeper needs a little bit more time, resource, right?
And was it okay?
Ultimately, it was fine. There were a few little nuances that weren't wrong. It was just it's a bit sloppy. It could be done a bit more speedily.
Let me get this straight. You told us a story about a potential problem that wasn't. So there's no ending to the story. This is like you criticizing me 4 episodes ago for going, so you wanted an updated version of a book from a dead guy.
So for the listener, we bring Topher onto this show so you can feel smarter. The lesson is you have to be dialed in your numbers.
Yes.
Your accounts are reflective of your operations, right? So it's not abdicate to your accountant and hope to God that it's right because they're an accountant.
Amen.
You know your business. Get financially literate. Which leads us perfectly onto somebody who isn't financially literate.
Oh my God. Fail of the week.
Fail of the week. And this is a new record, Topher. In nearly 200 episodes of this podcast, we've never had the same failure on twice.
Okay, to be fair, we've only had failure of the week for the last 15, 20 episodes since I've been on. You didn't have first 180 didn't count.
But that makes my argument less compelling.
It does. All right, so yes, so this is the first time in the 193 192 episodes where we have called out a fail of the week, not once, but twice. And if ever there was somebody who deserved to be called out, it's this Yahoo.
Yeah. So once again, it's Sam Bankman-Fried. And he's the guy, the founder that was...
Just look at that guy.
Behind... They've only got half a headshot of him on the website. It's you can't take a photo correctly. But he was the guy behind the FTX cryptocurrency exchange. right? He was the guy behind the FTX cryptocurrency exchange. So less than 2 weeks ago, on the Tuesday, he was worth, on paper, $15 billion.
Yeah.
On the Friday, his company's in bankruptcy, and his net worth has been absolutely destroyed.
Yeah.
And look, I mean, this is unbelievable. This is still playing out, to be clear. So it might be clearer once this podcast gets aired. But I'm telling you, this is this decade's Enron.
With what, 900 million in assets, but 9 billion in liabilities. I think you might be right on that one, my friend.
Well, and it's stunning. And we'll put the link to the article. It's brilliant. So my favorite thing
this article is snotty as hell. I love it.
Well, it's Financial Times, and yet it shares the actual Excel file. So this company's balance sheet was on Excel, and the metadata says it was created by Sam Bankman-Fried himself, right? And don't get me wrong, I want to be clear to the listeners. I frequently export data from my company's accounting software into Excel, and I'm manipulating it all the time.
Certainly. Also, to be fair, your company isn't a $900 billion business either.
That's fair.
Yeah.
Close.
Yeah.
Working on it. Let's see what happens in this next recession. But yeah, and if you just look at the line items, let me see if I can jump in on the on this file. If you look at the line items on this Excel document, like there's a line item, row 23, which says hidden poorly, internally labeled flat at account, and that's got $8 billion.
It's just it.
No, but look at the next one. Line 24, withdrawals on Sunday, $5 billion.
I believe that's called petty cash, isn't it?
Yeah, I found it down the back of the sofa. So look, clearly, not everything was right. How do you have liabilities that are 10x your asset? And the answer is a load of funky accounting policies.
Yeah.
Often, again, I want to be clear, it remains to be proven. But this, if it walks like a duck, if it quacks like a duck, right? It's like this situation is dodgy as hell, and the fact that it got this far.
No question.
If this isn't criminal, it should be. Right? Because at the end of the day, who's taking the bath? The investors, the shareholders. So this guy has...
The poor people who invested in the stakeholders.
Right.
That bought the Bitcoin. Or whatever they called it. The crypto.
Well, yeah, this was a crypto exchange. But all that money's gone, and it's not coming back. Now, the UK I love the fact, so for some people are going to hate this, because crypto is decentralized. We hate the central bank, so let's not have regulation. I want to be clear. I'm entrepreneurial. Generally speaking, I'm in favor of low regulation, like free market economics. Mm-hmm. However, there are points when it makes sense, and this is a perfect example.
Yeah, no question.
It's like, if you're complaining about it, that is. Like if there's somebody that's taking a massive bath and goes, well, take the rough with the smooth, and that happens in a volatile new industry, right? And crypto, in my opinion, is still
it's big.
The internet in the 90s, right? Yeah. It's kind of like
it's the wild, wild west, to use a U.S. term. You probably get that.
Yeah.
Right? Just there's no rules out there. The rules are being written as they go along, based upon what didn't work yesterday.
Well, I mean, look, and I've said this before, Topher, that cryptocurrency will change the world, and the world is changing. However, the crypto crash of this year, or this kind of recent time period, is equivalent to the .com boom and bust of the 99, right?
Yeah. What do they say? History doesn't repeat itself, but it sure does rhyme.
That's exactly spot on. And it boils down to this guy either didn't know his numbers really, or he knew his numbers, but he manipulated the numbers, and sooner or later it comes home to roost, right? Yeah. And so absolute frame rate.
I gotta say, you don't get to that level and that size without knowing your numbers to some degree. He had to have been aware at some level, I would think. I mean, who knows? Like you said, we don't know. We got to wait till it comes out.
So the question,
it's quacking like a duck.
The question. In fact, I've got to tell my favorite
Warren Buffett quote?
No, Enron's story. So this is from the book that I mentioned, The Smartest Guys in the Room.
Yeah.
And so here's how they summed it up with how the accounts were manipulated, because Enron were massively regular. They had auditors, right? They had to be audited, public company, blah, blah, blah. And so here's how it would roughly go down metaphorically. They would go, okay, they're like, our P&L is a dog, metaphorically. Our P&L's a dog, like it's a dog of a P&L.
Yeah.
And we don't need a dog for the market. We need a duck because we need to keep the share price up. We need a duck. We've got a dog and we need a duck. And they go, And they go, right, how do we create a duck? And then
From a dog.
From a dog.
Yeah.
And then they'd say, okay, let's look up the accounting definition of dog. And excuse me, I'm mixing my metaphors now. We want a duck.
I'm lost, but I'm into it because you said dog.
Hi, Macy. So we've got a dog and we want a duck. And they go, what are the accounting definitions? How can we justify this as legitimately as duck?
Like, we know it's a dog, but we need to find a way to legally call it a duck.
Correct. So they went to Arthur Andersen, who at the time were one of the biggest auditing firms in the world. Right? They're now bankrupt, by the way. Enron took them down. But they said, what are the definitions of duck? And they went, well, the accounting definitions of duck are has a beak, has orange feet, and has wings. And they would go, great. And then they would literally go, again, metaphorically,
yes,
and they would buy fake wings, strap it to the dog. They would paint the dog's paws orange, and they would strap a beak to its head, and then they go, here you go, Arthur Andersen. We have now got a duck. And apparently, to give, well, I don't want to give Arthur Andersen credit because they were found culpable as well, and that's why they went bankrupt. But ultimately, Arthur Andersen went, that's not a duck. That's ridiculous. That's not a duck. It's a dog. To which the Enron chief senior executive went, what do you mean? It's clearly a dog. And they go, it's not. You've taken a dog, you've dressed it up to make it look like a duck, but it's not a duck. It's a dog.
Can I just say, by the way, that with your accent and my American ears, I can barely tell the difference between duck and dog.
Okay, I'll translate it for you. It's not a woof woof. It's a whack whack. Right?
It works for me.
And then the Enron executive said, you said it yourself. You said, if it's got wings, if it's got orange feet, and it's got a beak, it's a duck. And Arthur Andersen would look at it and go, okay. I guess it's a duck.
Wow.
And that metaphor, and if you read the book in terms of how they did it and how they manipulated to say, no, it showed up in the form of things like...
And they literally had that transparent of a conversation where with the one firm going, this is not the way it is. The other one said, the definition says that we can interpret this way. And they're like, okay. Jeez.
Right. And by the way, it was prolific because effectively, from a revenue recognition point of view, it should have been earned over a long period of time, long contracts, but they found ways to manipulate it with this woof woof conversation in order to recognize all the revenue up front and have all the expenses a long way into the future.
Wow.
Right. And all of this relates to small business, because the question that I hope we are awakening in the minds of the listeners over is, well, how do I get educated, right?
Or the viewers, if you're listening and you want to watch, go over to YouTube, subscribe, give us a 5-star, and a comment, I think is right. Yeah.
I'll have 5. Yeah. Only 5-star. We don't take 4-star. The 4-star button's broken, so
is that it? Yeah.
So how do you do it? So look, a great book on this topic. He's written 2 great books.
So this is the book of the week.
It's the book of the week.
Okay. Not just a second bonus book. This is the actual book of the week.
Yes, the book of the week this week is Simple Numbers 2.0.
Love that book. Really, by the way, interestingly enough, I did not like Simple Numbers. Didn't like his first one. Yeah, no, I didn't like his first one. I'll tell you why I didn't like his first one. I didn't like his first one because in the book, he talks about how he recommends that all of his clients are on a cash accounting basis.
Did he really?
Yeah. But then, and here's the part that frustrated me. And then he starts giving examples of people that aren't in cash accounting and exceptions to the rule. I'm like, man, you're confusing. First off, business finance admittedly is confusing for most people. Don't confuse them by saying, this is what I recommend. Here's some exceptions and how it worked out. That's why I didn't like that one. But I did love Simple Numbers 2.0.
Well, yeah, I mean, look, again, I'll give the headline. If you like the sound of this kind of simple summary that I'm going to give, then go out and check the book for yourself. I think, ironically, given the book's title, Topher, I think the problem is business owners wish that it was easier to understand, and it's the wrong wish. You should wish that you were better.
Oh, that's a great frame.
Right.
Don't wish that it was easier to understand. Wish that you were better.
Yeah. I mean,
love that.
people sometimes wrongly attribute that to Jim Rohn. It was actually me that invented that.
Was it?
Yeah.
Oh, interesting. Well, that's good because Warren, who's listening, I'm sure has been falsely attributing that to Jim Rohn the whole time.
I kind of feel like some of our humor might be lost. I just want to say explicitly that's a Jim Rohn quote. I know.
Yeah, I was with you. 100%.
Really?
100%.
Okay. Anyway, so Greg's a smart dude. He's actually an advisor for one of our mastermind members, but he does a great job of breaking it down.
This is Greg Crabtree.
Greg Crabtree, the author, of breaking it down to some basic elements, which is useful. Because the reason why it's Einstein to say, make it as simple as possible, but no simpler.
Yes.
Right? And the fact is, accounts, there are multiple scorecards, and how they play out is different with different business models. So there are multiple variables that you need to get educated on. That's why, with your comment about cash counting or accrual, it's an oversimplification to go yes or no. You have to understand this. Well, there is, in my opinion, a dozen accounting terms that you have to understand before you can even have a conversation.
Yeah,
right?
Sure. Yeah, you got to learn the language before you speak it.
Which, by the way, is covered in my business finance masterclass.
And it's also covered in your book. Revenue is vanity, profit is sanity, but cash flow is king.
I can't believe that you get that wrong every time.
Did I say?
How many weeks have we been together? Turnover is vanity.
But see, turnover in the UK
just keep
is
digging.
revenue
keep digging.
in the States.
Yeah.
So I did actually kind of get it right.
So what Greg does in this book, I mean, really, there's two kind of key parts. One is key P&L stuff, right? How to keep an eye on your right ratios, how to make sure that your margins are healthy, etc., etc. But the second one is an overlooked concept for scaling, which is ROIC, which stands for Return on Invested Capital.
Yeah.
And ultimately, think about it this way. These are my interpretation, not Greg's. Growth costs cash. And I'm going to say typically, I'm going to say in all cases, one way or another, if a company is scaling, it's going to require more assets at a certain point, whether that be cash, whether that be stock, and whether that be non-balance sheet assets such as employees, right? It needs to grow a team and it needs to have the money. So in order for it to be stable and healthy and withstand the ups and downs of business, it needs to have that buffer. But it's got the Goldilocks principle. You can't have too much, you can't have too little, because most businesses are undercapitalized and therefore weak, and they try and expand, they overtrade, they go broke. Yeah. But inversely, if a company just has a massive mountain of cash, the investor's getting shortchanged because that cash is being put to work and inflation is eating away at that.
Wow. And
most people listening to this are doing the exact opposite of what they should be doing. Most are sat there going, oh, I need to invest this money that's in the bank, when actually they're so, in relative terms, weak that they actually need to stockpile cash. Yeah. And there's people that are really conservative. They've got a big pile of cash going, oh, I need to be more conservative. When actually they've got plenty of capital. What they are doing a disservice to their investors by they're not investing that because the cash isn't generating a return for itself.
By the way,
it needs to go into cash flow.
When you just said investors, that triggered off for me the part of the book that I really enjoyed in Simple Numbers 2.0. is that he did a really great job, I think, illustrating how a business owner, to really understand their numbers, needs to look at their numbers not as a business owner, but as an investor in the business. And I thought that was a really cool perspective, right? To be able to go meta and go, if I was an investor in this company, what would I be saying to the business owner right now? Would I be getting down their throat? Would I be yelling at them? Would I be demanding something else? And I love that concept because I'm honest, to be fair, I mean, full confession, I don't think I ever looked at my business from that perspective.
I love that because you've got to wear both hats, right? Both are applicable. You can't, it's not one or the other. like you've got the MD or the CEO hat, and there's the operations.
Yep.
And by the way, Topher, I'm going to say this completely ad-libbed. Remind me, because it needs to go in a future episode.
Okay.
Right? A book you will adore is called The Insiders, and it's about 8 CEOs. I think it's 8 CEOs who have had the highest returns on invested capital compounded over decades.
Interesting.
in the history of the world, of which my
and it's called Insiders.
it's called Insiders.
But by the way, for those of you who don't know, if Dan recommends a book, I read it, full stop. There are 2 people in the world that I give that to. That if they recommend a book, full stop. I don't question it. I just go buy it and I read it. So thank you for saying that. I will definitely go up and do
I'm
that.
trying to find the book. He's going to have a different title now.
By the way, you'll also be impressed. I did some research on Berkshire Hathaway, and their rate of their return on investment for their investors. I have the slide, so I'm going to have to do some estimates right now. But the average return on investment to their shareholders from, I think it was like 19, I don't know, like late 70s or something to the early 2010s, right?
Okay.
Produced an average return on investment of, and don't quote me on the number, but somewhere in the category of over 400,000%.
Holy crap.
Yeah. And you know what the S&P 500 average ROI is over the exact same period? Like 6,800%. Like, it was just this monumental number. And by the way, in fact, you're going to love this while you're researching this. The reason why I think this happens is because Berkshire Hathaway has a better feedback tool than any other financial analyst out there. Why? The average length of employment for a normal financial analyst is about 1.1 to 1.3 years. That's their median average, right? You know what the average length of employment is for a Berkshire Hathaway financial analyst? About 6 years.
Okay.
So think about this, right? An analyst is working for a firm. They make the recommendations. Before they get to see if those recommendations pan out, they get a job promoted to another firm. They leave.
Yeah, right.
And so they're constantly jumping from company to company without getting the feedback. But his stick around long enough to go, oh, that was a bad call. What did I learn?
Right. And by the way, I'll please this. I called the book the completely wrong title. I said The Insiders. It's called The Outsiders. So, which makes sense. That's what happens when you do it on the fly. The Outsiders, 8 unconventional CEOs and their radically rational blueprint for success.
We'll pop it up on the screen there.
Right.
The Outsiders.
The Outsiders. And so by William Thorndike. And it's an absolute gem, because it basically says there's 2 ways that a CEO is responsible. And most CEOs are well known for doing everything internally. Like, oh yeah, you increase your margins, you have better competitive advantage, you market and position yourself, right? All stuff valuable, highly useful, etc. But actually, it's the allocation of capital is the secret sauce, i.e. the reinvestment for growth.
Yeah.
So, I mean, if you think of Warren Buffett 101, generates this cash and then uses this cash to invest in or acquire other companies. And that's the compounded growth that makes him the greatest investor of all time.
By the way, I just want to point out that this is the 3rd book now that we have recommended in this episode, because we had one up at the beginning, then we had the book of the week, now we have this one. Our listeners and our viewers are getting way more bang for their buck. Like they only paid for 1 and we gave them 3.
Yeah.
That's a good deal.
What's the quote? I think some say that the advice is worth what the listener paid for it. So, no, but it's an epic book. I mean, look, clearly it comes across the fact that I'm talking about these 3 books, all of them spectacular.
Yeah.
It's kind of like, which one of these should I read? Yes. Exactly. You'll love that book. Yeah. Anyway, I could summarize it perfectly, Topher, by the quote this week is from another legendary investor.
Bring it on.
Peter Lynch, who says, never invest in a company without understanding its finances. The biggest losses in stocks come from companies with poor balance sheets.
Amen to that.
And that just ties back to they've got a weak balance sheet, they get blown over, they go broke, you lose all your money. Equities or investing in stocks, whether it be on the public markets or investing in companies, undeniably get the highest returns, but you've got to know what the hell that you're doing.
Yeah.
And the return of your capital is more important than the return on your capital.
Yes. And what I love about this podcast is that, first off, you and I don't always agree. I love that. What I also love about it is that you and I both really cherish counterpoints and opposing viewpoints, because that's how we become better. So we have a bonus quote of the week as well.
Yep. Yeah, I love it. So the bonus quote is by business magnate, or even titan, Henry Ford, the original Henry Ford, who said the two...
Wait. The original? Is there a copy?
Yeah.
Henry Ford?
No, there was Henry Ford II, then
gotcha. Okay.
Henry Ford III, then ran the company.
Okay, I'm with you. Yeah. Makes sense. You just put me on my
Yeah, so
all right,
the founder,
the founder
of Ford Motor Company said the two most important things in any company do not appear in its balance sheet. So the Bible, what we've said, do not appear on the balance sheet, and that's its reputation and its people.
Yeah.
And by the way, I love this because whoever it said that, genius is the ability to hold two opposing thoughts simultaneously. And that's true. You've got to be financially literate. But going back to Warren, he'll say, you can make a loss for the company and I'll be understanding.
Yeah.
But lose the company's reputation and I'll be ruthless. It's like reputation is what it's built on. It can take decades to build up and it can get lost in 5 minutes.
Yeah.
Bill Gates built one of the first $1 trillion companies, says that if you take away Microsoft's top dozen people, it would quickly become an average company. It's the people and how they behave are everything.
Yeah. Well said. Absolutely. I think that's a great way to kind of wrap this whole thing up, is to have all finance and then put it in perspective and check that it also boils down to a lot of reputation people.
Yeah. Right. Talking of which, see you back next week, because ultimately, if you want a better business, if you want a better business, Topher, you need to be a better business owner.
Well said, my friend.
I hope you enjoyed that episode. 3 things you need to do now. Number 1, make sure you subscribe to this podcast so you do not miss an episode. Also, get on over to Amazon to get a copy of my latest book, Turnover is Vanity, Profit is Sanity, 9.5 steps to improving your profits and cash flow. Also, join our Facebook group, the Turnover is Vanity, Profit is Sanity community, to connect with other business owners.